How does commodity index rebalancing impact individual prices? Have you ever wondered how changes in commodity indices can affect the prices of individual commodities? Let's break down the relationship between commodity index rebalancing and individual prices in a simple way. Commodity indices, such as the Bloomberg Commodity Index and the Standard & Poor's Goldman Sachs Commodity Index, track a group of commodity futures. Each commodity in these indices has a specific target weight based on factors like production levels and economic importance. These weights are adjusted annually to reflected changes in the market. During the rebalancing period, which usually happens at the beginning of the year, index managers make adjustments to their holdings. They buy more futures contracts for commodities whose weights are increasing and sell contracts for those whose weights are decreasing. For instance, if nickel has performed well and its weight is reduced, index investors will sell nickel futures. This selling can lead to a drop in nickel prices. On the other hand, if arabica coffee has underperformed and its weight increases, index investors will buy more coffee futures, which can raise coffee prices. This buying and selling creates predictable demand and supply flows in the futures markets. The impact is often more noticeable for commodities with larger index weights or those undergoing significant weight changes. Given that index investors manage over $200 billion in assets, their coordinated actions can influence prices, even if the actual supply and demand for those commodities remains unchanged. Understanding when and how commodity index rebalancing occurs is important for investors. It helps them anticipate price fluctuations and find potential trading opportunities during the rebalancing period. Since indices like the Bloomberg Commodity Index use a mix of production data and liquidity to determine weights, the rebalancing process ensures that the index accurately represents the global commodity market. This is beneficial for investors looking for ways to hedge against inflation or diversify their portfolios. In summary, commodity index rebalancing impacts individual commodity prices by triggering trading flows that adjust futures holdings to new target weights. This process influences market supply and demand dynamics during the rebalancing window, making it a key factor for investors who track or invest in commodity indices.